Hello everyone, welcome to Natixis. Welcome to Natixis CIB Research for this 2024 outlook. I'm very happy to have you back in this traditional session now of sharing views and the ideas for the incoming year. We are going to do three things today to discuss macro topics. First thing first, regarding the US economy, I think a lot of 2024 is going to be depending on what's going on in the US election to start with. And then we are going to discuss Europe, to discuss the global trend in the economy, to discuss with our Asian specialist. We have one of our colleagues from Asia joining us as well. So macro topics after that, US first and then the rest of the world. And to follow as this traditional market session regarding what our ideas going forward. Is it the year of the bond market next year? We shall see that. Maybe to start with, we just ran a survey with you, with most of our clients, and not surprisingly, but I guess what is striking is that the rising concern with geopolitics, obviously at any given year, the future is uncertain, that's the definition of it, but clearly the concern with geopolitical landscape is getting traction. We had last year the war in Ukraine from the invasion from Russia. Then today we have the Middle East. We have all this tension. We're talking about potential threat with Taiwan. Lots of things can happen as usual, but geopolitical risk is definitely at the center of everyone's mind going forward. I have to say this is probably as usual in a way. If we go back to 2023 as a short introduction, well, we were among the very, very few institutions not forecasting a recession in Europe, not forecasting a recession in the US, despite the inverted yield curve, despite this war in Ukraine, despite this huge energy crisis that we have seen after the COVID. So lots of institutions were forecasting double-digit recession in Germany and so on and so forth. Well, at the end of the day, probably German economy will decline by 0.1%. Europe will be probably close to 0.5%, so slightly avoiding recession, but no recession as a whole. And the US is showing a lot of resistance. We are going to talk that with our economist, but definitely well above expectation. And this recession never came above 2.4% in our view for 2023. So what about 2024? Well, the major change that we see is that in 2023, almost all the central banks in our scope were hiking rates like never before. The Fed has not done that in the last 40 years. The ECB has never done these 450 basis points of rate hikes. Never before we have seen that from the ECB. And all over the world, we have seen this huge move of hiking cycle from everywhere. 2024 is going to be the exact opposite of that. The vast majority, if not all the central banks of the world, are going to cut rates. Not as much as they hiked rates last year. It's probably a slower process to go back a little bit lower, but still, the vast majority of central banks are going to cut rates next year. Even today, in November, in October, you had more central banks cutting rates than hiking rates. So that would be the name of the game going forward. And that's a massive change for asset allocation, but as well for economies. Why central banks are able to do that? Well, first thing first, because inflation is going down massively. You remember last year all this debate about wage spiral, about this temporary or not aspect of inflation. At the end of the day, 1 year after that, maybe we can say in 2 years' time, probably inflation going to go back to its new normal, which is not below 2%, probably a bit above 2%, but not that much, in fact. Last year in October in Europe, we were at 10.6% of inflation. We are already at 2.9, below 3%. So it's fair to say that even if we're probably going to have a bit of a rebound of inflation, the scenario is one of inflation behave quite nicely towards this new 2% in 2025. So probably well above target still for central banks in 2024, sorry. But in 2025, probably not that far from 2%. So in our view, ECB, Fed, Bank of England, all the central banks that we are looking at, with the noticeable exception of Japan, the BOJ should be normalizing somewhere down the road. Turkey, maybe Russia, but that's probably one of its own kind. So the vast majority of the central banks are going to cut rates. So the financial conditions are going to be less restrictive, well, slowly but surely more accommodative. So that's the first thing. Then if you have lower inflation, you will regaining some purchasing power, which is probably a good story for consumption. So it's a good story for Europe, especially. Europe was very much hit by inflation in terms of consumer. But think of energy crisis. We are going to discuss that. But the energy crisis is probably not over because we are entering a new transition, which is going to take time toward electrification of the world. But still, you have the stock of gas in Europe today in December at 97% full. Never before we have seen that. And on top of that, the French nuclear is back on in a way. So we are exporting in France again some electricity. We see that the transition to a renewable is accelerating like mad. A country like Portugal has few days with 100% of its electricity done only with renewable energy. Year to date in Germany, 51% of electricity produced in Germany is out of renewable energy. It's not to say that we have no more challenges, obviously, but clearly this idea of that we had last year, that the spike of the energy crisis was behind us, is even more so in 2024. So the inflation of energy prices going down. We see the service prices going down as well, which is another illustration that probably the labor market is normalizing as well. We don't see this wage spiral. When we look at the wage trackers, we can start to see that wages negotiation are probably a little bit less than in 2023 going forward. So we don't have this wage spiral. So long story short, to say that our forecast for inflation next year is one of decline of inflation. So central bank will be able to cut rates quite significantly. You will see that in a short while with our economists and strategists. So basically, it's not a Goldilocks scenario. It's not soft landing scenario, but it's very look like it's still in our scenario. So we're going to discuss that first with our macroeconomist and then with our strategist. So first thing first, I will be asking the question, but the more interesting is if you are asking the question and they answer your question. So please do not hesitate. Use as much as possible the Q&A session, and then along the way, if you can ask questions to our economists and strategists, I will be passing the question. I'm very happy to welcome our two US colleagues, part of the US team. We have Christopher Hurd joining us. He's our chief economist for the US. He's joining us from the Federal Reserve. So we might discuss a little bit what the Fed might do with Christopher as well, but many subjects for Christopher, and as well with Jonathan Pingle. He's joined the team lately as well, but we are very happy to have both of them in Paris today. So maybe to start with you, Christopher, the question that everybody is asking and start to ask, and that will be the name of the game of 2024, I'm afraid, is that what about Trump? What are the chances of Trump to go back, and what could be the major changes that we can imagine if Trump is back versus Joe Biden?
Thank you. Yeah, so under a new Trump term, I can see three primary policies that he would want to do. First, he'd want to extend tax cuts. The Tax Cuts and Jobs Act of 2018 cut taxes on most people. Those are set to expire in 2025. If conservatives control Congress, Trump would probably push to extend those cuts. That would provide a boost to growth, but would also cost about $3.5 trillion over the next 8 years. Two, he would continue to be hawkish on trade. He's floated the idea of a 10% tariff on all goods coming into the country. It's questionable whether or not that is constitutional, but I think he would probably try to do it. And three, any sort of efforts that the Fed has started to boost bank capital in the wake of the banking stress from March 2023 would probably come to a halt under a new Trump presidency.
Well, which leads me to a big question, because we are talking about tax cut here and the prolongation of this sequence that we have seen in the past. But the big concerns we start to see, we didn't see much of attention around auctions, but still in the US, in a way, the US is starting to be more and more European when we talk about debt to GDP, and we see that debt to GDP in the US is very close to French debt to GDP, to be honest, and the projections are quite eye-popping. So the question is the following on you. Do you think we have the Biden and then Trump, they have what it takes in terms of means to provide a boost to growth in 2024?
A boost to growth in 2024? Well, as far as government spending goes, that did provide a tailwind to growth in 2023, about 50 bips. We don't think that's going to happen in 2024. We think the effect from government spending is going to be about flat. So that's going to provide not a boost in 2024 growth.
What we have seen as well is probably the major impact of Inflation Reduction Act on investment. We've seen this booming investment into the US and from outside the US into the US. How do you see that going forward? Especially Trump said that he wants to get rid of it, that the electrical vehicles are against American culture and so on and so forth. Is it serious or not, this potential rolling back of IRA?
I don't think he's going to roll that back. Most of the investments have been done in conservative places, so those are not the places that he would want to turn off in any way. But we don't think that investment from the IRA is going to be very strong in 2024. We think most of the low-hanging fruit has been picked.
Okay. Last year, 1 year from now, we were in the middle of a not banking turmoil, not a crisis, because when you look at the violence or the magnitude of the interest rate cycle by the Fed, at the end of the day, it was quite okay, the impact of the banking sector. Well, we could have expected more of kind of stress into the market or into banking sector. But still, if we look at the regional bank story, what is your outlook and what are the vulnerabilities? Because we see a lot of tension in the commercial real estate, for instance, which is probably one of the vector for tension in the regional banks.
Yeah, so the large banks are doing perfectly fine, but the smaller banks, profits are way down. Profits were down 20% on the year in Q3. Profits are being held back by HTM portfolios, including and the fact that smaller banks have to pay up to keep cash on hand. Now, these smaller banks are the primary credit extenders to small businesses, and small businesses are the primary job creators in the U.S. as well. So that's one of the reasons why we think that the Fed is going to be proactive about policy. And we see the first cuts coming in May, and we see cuts in every meeting after that for a total of 150 bips in 2024. And we think 2024 will end the year at a terminal rate of 4.
So yeah, this is starting. So it's more than a pivot. It's a slope now. Very interesting. Thank you, Christopher. I see we have some question on the ECB, but we will be talking about the ECB rates after that. Just to stick with the US economy with Jonathan, what was striking last year, as you said, the public consumption with deficit was very large. I think it was close to 7% deficit in the US. But the other engine of growth was definitely the US consumer. It never dies. But what's left in the tank of the US consumer, because excess savings were impressive? How far are we from not having any more savings in the US?
Yeah, I mean, so the US consumer this past year has really been relentless. Since the pandemic, the US has added over 3 million jobs. Wealth has been at historic highs, and personal consumption rebounded in real terms back to the pre-pandemic trend about a year and a half ago. We estimate that, largely due to government subsidies, the total excess savings above trend at about 2.1 trillion. And we think that we've seen, as of about a month ago, 1.8 trillion of that spent down. we see this kind of ending in Q2 and the consumer really running on fumes as they start to rely increasingly on credit.
And where does excess saving is coming from mostly? Because if job market is deteriorating, then it's going to be an issue. But where does it come from?
I mean, the job market has been extremely strong for the past year and a half. So a lot of these things have come or been continued due to wage growth. However, it was primarily due to government subsidies. The CARES Act and the American Rescue Plan were really, both from stimulus checks and other different factors, the primary builders of this excess savings.
So it's rolled back now. So it's probably plus the student loans and everything. It's probably there.
There's a lot of other factors there too. Yeah.
And what about inflation? Because how much inflation is important in the picture? Because probably it has eaten, in a way, the potential of consumption in the US. On the contrary, we can argue that going to next year, if we have declining inflation, maybe the US consumer will be gaining some purchasing power in real terms.
Yeah, I mean, it's been remarkable. I mean, again, over the past year and a half, we've seen real consumption above trend, but we've seen real income lower than trend. So consumers are really spending money they don't have, or spending down savings, and that can only continue for so long. Over this next year, we expect core inflation to continue to come down, ending the year for core CPI at 2.1%.
At the end of next year, 2.1%.
At the end of next year. And we think that gives the Fed, ample room to cut by May. And while the consumer is really going to have to pull back as these excess savings run down, at the end of the year, we can start to see that coming back.
And what about the maybe last question about the labor market? Because a lot of that is due to the dynamics of the labor market. We start to see this 3.4 to 3.9. How much of a deterioration of this labor market or normalization? Because I think it's fair to say that the great resignation is over. I don't know if your view on that. I'm curious to hear about that. But how do you see the labor market in the US?
I mean, we definitely have seen the quits rate come back to a pre-pandemic level, which is definitely a good thing to signal that the great resignation is over.
Not that good for wages, but...
Not good for wages. But however, looking ahead, we see unemployment rising throughout next year to about 4.6% by the end of next year. And this goes along with the small business story that Chris was talking about earlier. Small businesses are disproportionately I think over 50% of new hires come from small businesses, slightly less than that of total employment. But as stress comes under that, we're going to start to see stress coming in the labor market over the next year.
Maybe last question for you, Jonathan, on Argentina. I know it was a bit of a concern. We were talking about de-dollarization because maybe Argentina and Brazil at some stage would have come with a common currency, and then Milei comes and say, well, I'm going to go for full dollarization of the economy. And now, actually, it's off the agenda already. So what's your take about Argentina? It's a question for our chief economist in Benito Berber, but Jonathan, as you are his representative here.
Yeah, I'll fill in for Benito here. But no, I mean, I think it's a positive overall story. However, a lot of these more radical things are going to have to be pulled back. And we've already started to see that happen, Dollarization's, almost out the door. We'll see how that ends up going. But without having the backing in Congress, Milei is really going to have to step down some of his policies and see what he can work with just, center conservatives to be able to do. He hopes to cut down the number of government ministries. He hopes to start to privatize some of these public institutions. And that could also come with some real backlash from the public, and that's one other thing to look out for as we come into 2024.
I have to let you go because the time is there, but just one question from the audience. We see the St. Louis Fed indicator predicting a decline of the Q4 GDP. Do you feel that finally we are going to finally start to see this recession coming in the US in the next 2 quarters?
We wouldn't define it in that particular way, but Powell has said over and over again that he thinks that a period of below potential growth would be needed to bring prices down. We have growth in Q4 at a little over 1% and a little over 1% in Q1. That would be far below potential, and we think that's going to give the Fed the room to cut in May.
Thank you very much, Christopher and Jonathan. That was it for the US. If we have some additional question on rates, we will try to deal with it on the next session on the market. So all in all, to summarize, in the US economy, probably US economy will be seeing GDP growth divided by 2, but it's still not, as we call it, a recession. It's a deceleration. It's not a normalization because probably the potential GDP growth is above our target of 1 plus something for the US economy, but still for the US, deceleration, a lot of noise going to be made around the US election, but like Christopher said, probably, well, between words and facts, maybe we have to study, to look into that. That will be your job for the next month. Thank you very much, guys.
Thank you.
Thank you.
So now we're talking about the rest of the world. So we started with the US. Now I'm very pleased to be joined by our rest of the team, well, part of the macro team. So starting with Ina Mufteva. Ina Mufteva is in charge of our emerging analysis within the research. Dirk Schumacher, the boss of the chief economist for Europe. We have Garian, he is our economist for China and Asia. And Thierry Cherel, our specialist of real estate, because we think that in China we have lots of subjects we have many subjects for this big economy for sure, but clearly real estate is probably one of them, and we can have this discussion. But maybe to start with Ina, because we published a paper on that of these new trends of the global economy. We care about deglobalization, nearshoring, friendshoring. At least the economy is not, the globalization as we knew it is dead, and we are seeing other trends. So maybe first question for you, Ina, the deglobalization of trade, is it a reality or not?
Well, thank you, Jean-François. Happy to be here. The short answer is yes. This is definitely something.
Thank you. Next question.
This is definitely something we're seeing in the statistics. So the favorite statistic of the economist that everyone is looking at is the share of the global trade in the world GDP that stabilized actually since middle of the years 2000, after continuously growing for more than 30 years. Like it took around 30 percentage points before going to this kind of a stable level of the 56%. Another interesting statistics to look at are the cross-border investments, the FDI, the foreign direct investment. So the total global foreign direct investment in the percentage of GDP peaked actually around at around 5, just above 5%, around the global financial crisis, and then it actually decreased because the plateauing of the global trade in the percentage of GDP meant that there was no need for so much of new investment, right? Just a couple of words on why this actually happened. So a number of events recently, starting from the COVID-19 pandemic, from the Russia-Ukraine war, Brexit, deterioration of the relationship with China, between the US and China, on trade and geopolitics. So all these events brought some sort of skepticism about the benefits of the globalization. So the countries are actually pursuing a more protectionist policies ever since. And so when we look at the number of trade barriers actually increasing recently. So definitely it's a reality.
Yeah, in 2010, I think we had 250 trade barriers. Last year, it was 10 times this number. So it's impressive. The world is closing itself. Second question for you. And what are the consequences of this fragmentation? Because, like you said, it was the peak is behind us in terms of globalization. What is the macroeconomic consequence of this fragmentation?
Well, obviously the impact of estimating the impact of this trend is a bit tricky because it really depends on what channels, what degree of the fragmentation you're looking at. So if you look at the recent paper of the IMF, they consider the geo-economic fragmentation as purely policy-driven fragmentation, and they estimate the cost of that, and this is what you see at the screen on the chart, at around 2% for the developed and emerging market world, but twice that for for low-income countries. Sorry, and other studies actually confirm that the fact that developing nations will be suffering more from this slow globalization, actually stabilization of the globalization, as we say. And another interesting finding of another study is about the global investment in renewables that is supposed to go down by 30% in case of this full segmentation of the minerals markets. So if we want to continue the green transition, we will have to think about the global trade.
Thank you, Ina. And last question, maybe on this still regionalization of trade. Again, when you have analyzed all this flow, how do we see this friend-shoring story, this near-shoring? We start to see, it started with the COVID. We just realized that the supply chain were quite fragile in a way, and we had to be more resilient in that matter. So how much of a reality, or is it accelerating this friend-shoring, as Janet Yellen first put it?
Yeah, well, regionalization of trade, probably we will not speak about the full regionalization, but again, it's something that we start to see in the figures. So if we look at the South-South trade, actually it increased a lot. So we looked at the J77 club. You heard about the J7 club, and this is the J77 club, so International Organization of Developing Nations, UN members. So the trade among these countries increased from 36% in 2007 to 46% in last year, actually, to 2022. World Trade Organization speaks about the decrease in the diversification of the trade partners among the world. So definitely friend-shoring and near-shoring is something that is happening right now. And one of the reasons why I said the full regionalization seems implausible is the fact that well, going back to the green transition, if you want to keep the green transition, we'll have to take into account China, because actually it's processing 85% of the rare minerals, and it's a dominant refiner of the copper. So it will be difficult to go without China.
That's a perfect link to the French session when we receive this sovereign wealth fund on the critical metals this morning. France has launched an initiative in Europe to have a critical material fund, infrastructure fund. So very interesting. So turning to you, Gary, first question on maybe Asia in general, but China in particular. How China is going to do next year? I think we were close to the bullseyes in the number for this year, but what about next year, China GDP growth?
Okay, sure. Of course, if we look at China's situation right now this year, because of a low base effect, so we are quite likely to see China growing at 5.2%. But for next year, actually, it is really the time that China will see the real challenge, because if you look at all those problems in the real estate sector, then property investment falling 9%, fiscal land revenue falling 20%, then it would mean that Chinese economy will continue to face quite severe headwind together with this weak consumer and business confidence. And however, at the same time, we will also see some of this silver lining. At least credit growth is still growing at 9%, retail sales still relatively resilient at 7%, which means that China will probably decelerate to somewhere around 4.5%. It's definitely not a doomsday scenario, but we need to accept that China will probably decelerate in a longer term to probably to around 3% in the next 10 years.
Question that to maybe to bridge the gap between Ina and China. Let's say what we to put it. It's weird to put it that way, but no, clearly what's happening in the world trend of trade with China, is it fair to say that China is more and more domestic-led economy, and all this investment from abroad, which are decelerating massively in China? I think of the US, the foreign direct investment from the US into China has been divided by 2 in the last decade. Mexico, Canada are now the major partner of the US at the expense of China. So my question is the following: is China more domestic, and the rest of Asia is benefiting from its rebalancing out of China into alternative to China?
Well, I think if we start with this question with some numbers, if you compare to China, let's say 20 years ago, FDI actually forms around 5% of its GDP. And nowadays, if we forget this year because there is like a negative net outflow, then for last year, it goes to around 1% of the GDP, which basically means that China is not that reliant on paper to FDI for growth comparing to the past. But however, it doesn't mean that there is no consequence, because in the past, China learn a lot of these new technologies through the cooperation with the world. So of course, China can still grow with massive subsidies and also industrial policies, of which many governments nowadays are doing the same thing, but it will not be able to achieve the same efficiency versus the past era that will be able to cooperate with different countries.
And what are, in your view, Gary, the major winners of this rebalancing of economies in Asia, especially?
Well, indeed, I think one of the advantage that a lot of Asian countries, ex-China, have is that when you have all these industrial policies, let's say from Europe or from the US, in specifying where they can import from, then you will see a very strong shift from a lot of companies that they need to source the production from India, from ASEAN, etc. And of course, beyond this lower labor cost like a factor, it's also about this de-risking approach that companies want to separate the supply chain because they do not know how to manage the risk. Then the best way is that you diversify. And beyond that, I do think there is another type of opportunities of which, for example, South Korea will be able to capture. For example, I will give like a scenario on the electric vehicle battery that China produced 60% of global electric vehicle battery. But if you look at non-China market, Korea actually produced 50% of it. So definitely we do see growth opportunities in this de-risking approach across the world.
Yeah, and we see lots of batteries, even in Europe, in France, in Germany. We see some gigafactories, 4 of them already in France, just for France. Impressive rebalancing there. A big risk of China this year, and the question, is it going to continue? Is it let's say, a never-ending nightmare for China? I'm talking about real estate. It used to be close to 1/3 of Chinese GDP. Now, I guess with the declining of prices in real estate, it's less than that, but still, how much of a problem or trouble is it for China and maybe for banks in China, this real estate story?
Well, I think the biggest problem that China faces in real estate is that, of course, it's not at a scenario that it will collapse completely in terms of, like a big financial crisis. But at the same time, it also means that it's missing 1/3 of the growth engine all in a sudden, which basically means that growth will decelerate. And amid this process, of course, if we think of the banking sector, which is a very important policy transmission to in China because it forms 50% of the credit in China, then banks will need to take the burden, which basically means that it's likely that banks will need to absorb the loss from the NPLs and also about this lower net interest margin, etc. But the good news is that it's not something that is not tolerable in China, because one of the advantages that China has is that China has a high saving rate, which basically means that at the end of the day, someone will need to pay the price, but this time maybe it's hidden in the whole society that everyone will pay it.
Thank you very much, Gary. Maybe it's a good transition to Thierry on the real estate. I don't know if you have any ideas on Chinese real estate market, but I'm sure you have some ideas on the rest of real estate market, both in the US and Europe. So Thierry, where do you see the bottom of this real estate story in Europe?
Yeah, thanks for the question. We were discussing with Gary just before the emission about China versus the Western world. In my point of view, so European perspective is that in the Western world it's really a matter of interest rates, while in China it's a matter of oversupply, which in such an inelastic market as real estate, it's a longer topic to handle or more difficult. But I've seen some Chinese property development been blown out. Maybe it's a part of the solution. I'm not sure it's a good way to manage resource, but yeah, it could take time. But I'm not an expert on China. I'm an expert on Europe. So in Europe, we think that logistics has come back in its growth path. Has completely recovered, and now it's back again on its growth path. And we expect it to continue next year. It will be mainly driven by rental growth rather than yield compression. But we expect 5% growth in 2024 at least. And still, this is really our growth subsector. We also like right now the shopping center. It's been 5, 6, 7 years that the shopping centers has gone through difficult years with the different COVID crisis, retail bashing, being the translation of investor sentiment from the increase in the online market share growth, going in Europe, growing from 8% in 18 to 17% in 21. Now we think it's stabilizing. It will continue to grow, this penetration of the market of online sales. But in the end, the base effect and the dynamic will make the marginal competition for shopping centers even less impactful for rents. And then currently shopping centers and retail overall in Europe are providing very attractive income return, over 6%, which makes it very attractive in comparison to the other property asset class. Office, I think we should separate now the wheat and the chaff. So what's the wheat? The definition is really grade A office building, is really the ones which are well connected, central, newly built or refurbished. And most of the time they have green certification, so meaning that they are efficiency on their energy use. So the point is that this part of the market is only, let's say, 10, maximum 20%. So it's remaining the rest, and the rest is suffering very deep. We are seeing the full range of building which will suffer from the working from home trend, and companies flying to central locations. In the end, we think that it will be about -40, -50 in terms of value drop. It will be a lot of value destruction, and in the end, it's also go down into a long hand of value. I mean, the price decline will decline over the next maybe 3-5 years. It will take time.
Yeah, especially when we see these occupancy rates you were mentioning in the US, you see that for the 10 major cities, occupancy rates is below 50%, despite all this noise about people going back to, well, people ask to go back to the office. We see the occupancy rates still not normalizing and far from it. And the new generation, with aging, probably the new generation who are going to see some more leverage on that, and they want home working, so it's a bit of a change.
You're right, but interestingly, we are also hearing from some companies, especially in the US, and I would say liberal labor markets, that there's kind of a wave of back to office, which is not the case in France or Germany, or I would say Eurozone. And these liberal markets, I think it's more constructive for office, because definitely it's not, there's not the union, I would say, making the working from home within the job contract. And definitely it makes it more flexible. And I mean, such a wave could happen in 2024. It would be definitely beneficiary for US office, in my view.
In flex office, you have office. Okay, thank you very much, Thierry. Maybe I turn into with Dirk on European economy. So we see that Europe has escaped recession this year. How do you see what explained that this good performance that we, in a way, what it was our central scenario for this year? But how do you see the explanation why Europe escaped recession? How do you see going into next year?
Sure, I'm not sure it was really a good performance. It was a good performance to the extent that we evaded a recession, but overall still stagnating growth. Why did we not go into recession? The main reason is that, well, it was rather easy or easier than thought to replace Russian gas with other gas that many thought wasn't possible in that time span that it actually happened. And I think the robustness of the corporate sector is very important. So the corporate sector had a strong balance sheet, was able to invest, was quite profitable, and that offset the weakness coming from private consumption, which was dented by the sharp increase in inflation and therefore the drop in real income. So on a net balance, we had a corporate sector investing and a private household sector not spending much, and that led to this kind of stagnation we've seen.
And what about growth next year? Where does it come from? We talk a lot about Germany being again the new sick man of Europe. Is it a reality or not in your view? If you have a word on the budget after Karlsruhe ruling, and if you compare that to France, which had quite a good post-COVID recovery, but how do you see Germany and France next year?
Sure, let me maybe briefly on the euro area level, we just see the unwinding, if you will, of the drop in real income. We see real income rising because inflation declines, wage growth still pretty strong. That means consumer spending, all else equal, will pick up and it will drive growth. Also, the saving rate is still high, unlike in the US. There would be the potential to drive down the saving rate a bit if need be. Now, Germany is still the sick man, unfortunately, or semi-sick man. It's underperforming the rest, and the reason is simply it's hit by those structural changes more than other countries, i.e. the change in the energy transition. We have in Germany a lot of energy-intensive industries, decoupling from China, deglobalization, and the transition in the car sector. All that hits Germany more than others. France is also hit to some extent by these factors, but less so, and is having a relatively good performance, at least compared to Germany. So 0.5 percentage point more growth in France, 1.2 versus 0.7 for Germany. That's our forecast.
Thank you, Dirk. I think central to the scenario is inflation view. So it declined, like I said in the introduction, quicker than expected compared to 6 months ago in our last midterm outlook. But how do you see inflation in 2024? There are lots of questions about this new rate of equilibrium rate of inflation, stickiness of inflation. Where do you see inflation next year?
Well, that stickiness turned out to be not so sticky after all. I mean, inflation in November came down to 2.4%. Even core inflation started to decline. So we forecast inflation to be around 2% actually end of Q1, beginning of Q2 next year, which is then the ECB's target. So the main risk factor here is wage growth, which is still pretty strong, 5%. So some of that could come through in core inflation. At the same time, there is, when we look at corporate profit margins, they have been so big that there is the potential for compression. So higher wages do not necessarily have to translate into higher inflation. So overall, 2%, that's what the ECB wants. That's how it will calibrate its policy, is what we expect for next year, end of next year, and actually also for 2025 then.
Talking of the ECB, what is our scenario?
Yeah, we had to change it in light of the data and bring forward the first rate cut, i.e. we now expect in June the first rate cut, and then every meeting then 25 basis points. You could argue they should do it even earlier, but given that there's always some inertia in the governing council and the ECB, that it takes a bit longer to get a broad enough consensus, we think they will it takes a bit longer before they start cutting, but once they do, they will follow through. So a total of 125 basis point cuts next year. That's our call.
And maybe beyond the rate, is any view on the PEPP? And we hear a lot of discussion within the ECB and outside the ECB regarding reserve, for instance. So beyond rates, the normalization of the ECB monetary policy is going to continue?
Yeah, I mean, that's now well flagged that in the December meeting, they will for the first time officially discuss unwinding of the PEP. We expect that actually that will be announced then in the following meeting. Starting in April, they will wind it down by 50%, and then in the middle of next year, stop reinvesting. I let our colleagues in strategy discuss what that means for the market specifically, but that would be our forecast when it comes to QT.
Looking now, taking a broader view, because we discussed China and the global trend with Ina and Gary, maybe how do you see Europe? We start to see a bit of more assertiveness from Europe. How do you see Europe vis-à-vis China? How do you see these changes occurring in Europe regarding the external policy of Europe, first thing first, and how much dependent the European economy is from China?
Well, it's dependent, and then within Europe, Germany is more dependent, say, than France, for that matter. At the same time, the cyclical impact of China on Europe is not as big as many people think. So kind of a rule of thumb is 1% growth less in China means 0.1 less growth in Europe. Could be a bit more, but that in itself means that slowdown in China will not push Europe in a recession by itself. The decoupling, and Ina mentioned that the question really is how quickly will it happen? If it were to happen quickly, not necessarily because the economics would argue for that, but rather because of political changes, then of course that could lead to a severe recession if it were to happen quickly, which is not our baseline. And the green transition has to be mentioned here as well, as Ina already did. Without China or without the input from China, Europe will have a hard time making that work.
Thank you very much, Dirk. So if I try to summarize this session before moving to market strategists and analysts, clearly what our scenario is for next year is probably again, not a Goldilocks, but it's close to a soft landing. US economy going from 2.4 to 1.2, European economy going from 0.5 to 1% around, Germany reaccelerating, France as well a little bit. So it's a little more positive than the consensus probably on Europe. Gary, you keep our view that we are going to see China around 4.5, and this new, I would say, rebalancing of trade that Ina was mentioning is benefiting from the rest of Asia, starting with India. And Thierry, well, you are a little bit scary regarding the office market, but for the rest, probably 2024, let's say second part of next year, will be a bit more constructive. So thank you very much for joining us for this session. We move to the last session on markets. Welcome. So again, for this market session regarding 2024, is it the year of the bond market? I will start with Cyril, but before that, just to introduce my guest from the team. So Émilie Tétart, she's our analyst on cross-asset, or specialist of cross-asset portfolio allocation. Cyril Erigna is the head of the market team, market strategist. And Nordine Nam, within the Cyril team, is our senior analyst. I'm sure that you know Nordine, our analyst on FX markets. So maybe to start with you, Cyril, because the idea is 2024 the year of the bond market. First question, first thing first, what are our expectations for ECB and Fed, and what is the impact you can see, and maybe another way to put it, how do you consider our scenario vis-à-vis the market expectation?
Well, thanks for this question, Jean-François. Well, to be frank, we were pretty far from markets a couple of weeks ago. Now the market is more or less aligned on our scenario. We are very close, in fact, to the market view for 2024, as well, notably for VCP. We are expecting 125 bips of cuts. The market is a bit more aggressive, so we would be probably a bit cautious. And what Dirk mentioned about the timing of the first cut, according to the research, is very important, because we are expecting the first move in June, while the market is already expecting something by March of next year, which means potentially some disappointments in a couple of weeks, but for sure in 9 days with this very interesting ECB meeting, we'll know more.
What is striking as well is that is a move made already. Question to put that other way, in November we see that the total return of the bond market is 4.5. I think it's something we have not seen in 2 decades. So my question is the following: usually we see some bull steepening of yield curve when any given central bank stop hiking. What about this trade of re-steepening of the curve? Is it too late to play it, or is it the name of the game for 2024? Still?
No, it's not too late, and the move is very likely to continue, notably on the front end. This is where I think the biggest opportunities in terms of absolute evolution of yields are concentrated. 2024 won't be such a great year when it comes to, in fact, 10-year yields. We foresee, in fact, 10-year, notably bonds, underperforming quite massively, in fact, USDs, with a target around 2% for 10-year bonds. Much more interesting for 2-year Schatz, which is expected to end next year around 1.8%. So yes, we do believe in quite strong, in fact, bull steepening move both in the US and in Europe. In the US, we have the same kind of issue on the long end. We still believe that due to very strong supply by US Treasuries, we'll keep probably having term premium there, which is definitely justifying quite a strong steepening of US curve as well. So it's not too late. It's not too late, but the move on the long end has been already quite strong, but definitely more interesting in the US than in Europe for sure.
And what are, I would say, the the risk to this outlook? What is the thing you really need to keep in mind in your view?
Well, inflation. I think. Well, if you just look at how inflation has been evolving, notably in Europe, in 1 year, now the market inflation swap are pricing inflation around 1.7% in Europe, 1.7%, while 2 to 3 weeks ago, it was still above 2%. So decisive things to look at, of course, the prints we're going to have on a monthly basis, but more than ever, I think the new forecast delivered by the CIB in 9 days will be key, because people will be looking at a lot at projections for 2025 and 2026. In case these projections are below targets, then it could be the signal for even more excessive and exuberant cut expectations in Europe.
We have the question on the neutral rate of the ECB, depending on the inflation, obviously. Where do we see ourselves compared to the target?
Well, pretty in line in the end, because we see neutral around 2% in Europe. If you look at very long Ester forward rates, they are currently, let's say, seeing a bottom around 2.2%, so pretty close. But where there's probably the biggest distance between long-term rates and neutral, it's in the US, actually, because market is still seeing it around 3.4, 3.5, while we expect 3%. And this is the reason why US market is very likely to outperform the European one into next year.
Talking about US market and steepening of the curves, we have this issue, in fact, of US becoming more European, like I said with Christopher and Jonathan, in a sense that we see that the supply of treasuries is increasing European way. This figure in mind of 20 trillion over the next decade of new issuances by the federal government. So it's eye-popping in a way. And at the same time, and we are going to talk about de-dollarization with Nordin in a short moment, but at the same time, we start to see some traditional buyer of treasuries. I'm thinking of Russia, obviously, but more importantly, what the Chinese are doing, minus 40% if they are in their reserves from Saudis, 500 billion from the Chinese. So we get this supply-demand size or effect on the US curve. So my question is, do you start to see this kind of bear steepening due to this supply effect?
We saw it quite well this summer, and we are seeing it looking at US swap spreads. US swap spread on the 10-year maturity, you have a plus 35 BP asset swap margin, so minus 35 BP swap spreads, which is quite an historical, in fact, level for the US. So yes, the, let's say, negative momentum or negative impact of this oversupply on USTs is pricing and likely, in fact, to continue to do so ahead.
One word on maybe last question from me on the sovereign spread in Europe. A word, especially on Italy, well, not the elephant in the room, but clearly the usual suspects when we're talking about debt sustainability.
2024 is going to be okay. This year has been the same. We think that risk appetite will rebound, and as long as we have a bull market, and this is our expectation for next year, it's very likely it will make Italian BTPs much more resilient. So Renji spread against bonds on the 10-year, with Italian BTPs peaking at 190 BPs by March and going as low as 160 by September of next year.
ECB will be happy with that. No need for
Same for us.
in. Okay, maybe it's a good transition for we talk a lot about rate differentials, rates, the year of the bond market, obviously with Cyril. What about the FX market and especially the dollar? Dollar was having not a very good ride lately, and we see that the rate differential are still the name of the game when we look at the FX market. So what about the dollar going forward, Nordin?
We expect the dollar to continue to decline. It declined already quite a lot. In November, it declined by 4% when we look to the DXY index, and the trend is still negative, given that the Fed will cut the interest rate, and the dollar will fall against most currencies. Is due to also the fact that the growth is going to slow down quite a lot. We start to see some sign of weakness since the beginning of November, and it should carry on given our scenario, and we expect a contraction of the GDP in Q2. It should not be the case for other countries where we expect an improvement.
And what about euro?
So yes, we expect an improvement in the euro growth. The low point of the cycle profile has been reached already, and we expect a recovery, as Dirk said before. It's not the case, as I said just before. It's not the case in the US. So this dynamic in terms of a cycle should be quite positive for the euro, and as a result, yes, we expect the euro dollar to reach 1.13 at the end of the next year, and it should be supported also by the fact that there will be some deleveraging on the dollar position, speculative position, and clearly, yes, it should be quite positive. What we can say is that volatility is going to decline, given that we don't expect a big move anyway, and there will be many questions about the timing of the first rate cut in the US, in the Eurozone. So market will look to good levels, and yes, the volatility will probably continue to decline. It's standing at the moment at 6.4 for the 3-month volatility. We could reach lower level in coming month.
And maybe a word on GPY. Maybe BOG will be the only major central banks riding against the flow of cutting rates from central banks. What about the GPY in your scenario?
Yeah, we expect further strengthening of the GPY. We expect the dollar-yen to decline towards 135. It reached recently a high level of 152, and is standing now following the decline of the dollar and following the the decline of the US 10-year rate. It reached 147. So the trend is going to carry on, given that, yes, the Fed is going to cut the interest rate. Long-term are expected to decline. Dollar is expected to decline. And the last thing is what important is the BOJ normalization. We expect the end of a negative rate and come back to zero on the monetary policy, and it should lead to deleveraging also of a short position in the yen. As a result, yes, it should be positive for the yen.
A word on the de-dollarization, maybe to finish with, because it was one of the thematic of 2023. Probably is going to continue in 2024. This is maybe a structural trend. I don't know. What's your view on this de-dollarization? A lot of talk around that. Or do you see that?
Yeah, there was a lot of talk since the war in Ukraine, given that the US and most G10 countries...
The weaponization of dollar.
Yes, they freeze the Russian reserve, and as a result, yes, many countries are looking to avoid the dollar, and that's why there's a lot of topics about this. And but in the fact, we don't see really a big fall of the dollar. In fact, the dollar remain quite strong. It's overvalued at the moment, and when we look to fundamentals, and when we look to data, also the reserve still stand at 60%. Also, it's true that it declined a little bit, but yeah, it could be due to the fact that many reduce position on the U.S. Treasuries because the Fed increased quite a lot the interest rate. We see also that almost 90% of the pairs negotiated in the world are against the dollar, so it's still very important. So yes, I don't expect any dollarization even in medium term, so it could not happen now.
Thank you, Nordine. Maybe just to move to Emily on what we should make out of it in terms of portfolios. I guess this is what we hear is that it's a year of the bond market is going down, and we hear from Nordin that it's probably a weaker dollar world going forward, which is usually favorable to risky assets, to emerging, but not only. So, Emily, what kind of assets we should look at in the next year? So bond market, yes, but anything else?
This is probably a nice year for diversified portfolios that is coming, and in this sense, we share the view that are expressed that our client expressed in the survey, and we may have a year with gradual disinflation, soft landing of the economy, central bank pivoting. We may have a year where all the main asset classes will grow actually next year. So, what's interesting also in our view is that we may have a lower correlation between all these asset classes, with the disinflation factor starting to decrease and the focus to switch more on growth factor. We expect especially the equity govies correlation to decrease to more neutral level. This is a very interesting topic in our view for diversified portfolios. Equity bonds, where to tilt? Of course, we share the view also expressed by my colleagues that the bond market are very attractive, are more attractive than equities. Next year, the carry is attractive, the valuation are attractive, and the directional we expect on interest rates will be a very strong support for bond market next year. If you look, for example, at on the US markets, if you look at the expectation we have on the treasuries, my colleagues expect 100 BP I expect the T-notes 100 BP lower of its current level. So it's with a duration of 8, it's 8% that you can add to the total return performance. So it may help bond market to achieve higher return than equity market actually next year. And
you talk about bond equity correlation, which is always very important to look at. But and it's, yes, fair to say that it's probably the year of the bond market still. But what about the equity market in this scenario that we have within Natixis research?
On equity market, we are moderately optimistic too. We expect the S&P 500 around slightly below 5,000 maybe. We have, of course, because we do not expect any recession next year. So as we can see on the chart, the
soft landing is beautiful.
Soft landing is beautiful. So the average path of equity markets, if you have after the Fed hike, after the end of cycle, can be positive if you have no recession or if you are in a no recession scenario. And with the central bank's pivot, with lower real rates, the sentiment will improve, and the Fed put will be back. So it is a support factor for equity markets. On the more fundamental side, there are still some concern with disinflation. We have still a risk on margins that is not priced in actually. So fundamental risk on equity market that will compensate this more optimistic support factor on the monetary policy side.
Any thematic you want to play, especially for well, what is your favorite thematic for next year?
On the US side, we have techs that are very expensive, but still they are not so bad positioned in an environment where growth may slow a little bit, where rates are still high, so they can continue to do well. But still, the valuation is a risk on the tech side, and the concentration is a risk on the main US indices. if you take, for example, the S&P 500, 50% of the volatility is explained by 10 stocks, and it's 60% for the Nasdaq. So
80% of the performance.
yeah, so you may want to hedge this risk. In the QIS team at Natixis, they have worked on some strategies that you can use to hedge this risk, and you can also look to diversify the risk. And if we are in a soft landing scenario, I think what will be very interesting is to play the valuation catch-up that we will have on the less expensive segment. If you look, for example, at the S&P 500 equi-weighted, is not that expensive. We are near historical median level. So so this is very interesting. And if we want to play the more like a negative scenario of a macro slowdown and a more defensive scenario, we can use a mix of defensive sector and quality style, maybe.
Thank you very much, Emily. Thank you, guys. So maybe we wrap it up here to be on time. Thank you very much for joining us. Just to summarize the session. So in terms of macro picture, once again, it's a deceleration of the US. Growth divided by 2, but we mentioned that many times. This is not a recession per se. On the contrary, and probably a bit more optimistic than the consensus regarding Europe, a slight reacceleration of Europe because of decline of rates, and both economies are going to benefit from a true and quite substantial interest rate cut cycle by major central banks, and all over the world, the vast majority of central banks are going to cut rates into next year, and this is a cycle, just not one single event of that. And it's going to start in the US before the summer, in June for the ECB in our scenario. So this is a major game changer as opposed to 2023, explaining our view on economies, but not only, again, more purchasing power due to a lower inflation in our scenario. In terms of assets, like we said, again, year of the bond market, probably the rate differential is not going to impact that much the recent trend of lower dollar, which is favorable to risky assets. So probably it's not that obvious that the equity market is going to suffer that much in these scenarios that we have. Bond first, but something to look at in terms of thematics. And please read us with our publication to know more. This publication on this event with all the slides, all the data, all the forecast is going to be published before the end of this week. Do not hesitate to reach out to the team. Follow us on, obviously, X, LinkedIn, whatever. But more than anything else, do not hesitate to reach out to the team. We are more than happy to discuss, to visit, and to exchange views with you guys. Thank you very much again for being so numerous, joining us again this year. Bye-bye.